Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian stocks are likely to get off to a muted start in the earnings heavy week. GIFT Nifty suggests a flatter start coming in for Nifty 50 index. Performance is down by 0.15%. US stock ended mixed on Friday. Financials drag US banking shares ended lower as quarterly earnings disappointed. Let's talk about Asian shares. They faced headwinds on Monday after rally in US bonds and stocks hit a wall on Friday. Japanese markets are closed for holiday. Back home, the highest delivery has been seen in Power Grid Corporation of India, Kotak Mahindra Bank, Ambuja Cement, Gujarat Gas and Coromandel International. Let's talk about FIIs. They've bought shares to an extent of 2,636 odd crore and DIIs have sold shares to an extent of 772 odd crore. Now, earnings that we like to watch out for, it's going to be an earning heavy week. Almost 35% of the Nifty Index weightage will be reporting in with the numbers. Something like of Infosys, HDFC Bank, RIL are going to be the ones that are going to be, dictating the market trend in this week. But in today's session, what we'd like to watch out for, HDFC Bank, LTI Mindtree, Tata Alexi, Tinplate Company, Central Bank of India, CRISIL, Hathway Cable. These are going to be some of the companies which are going to be reporting in their numbers today. In terms of FNOQs, what we have on the list, 85 of them have seen a long build-up, and that includes like of Intermart, Intermesh, Oracle Financial, RBL Bank, Coforge, and Bosch. These are 85 stocks essentially which have seen long build-up based on the OI percentages. Almost 8 of them have seen long unwinding, and this includes the like of Interglobe, Reliance Industries, Titan Company, and HDFC Bank. Heavyweights essentially. 24 stocks have seen short build-up, and this includes the like of Power Grid, MCX India, Gujarat Gas, Kotak Mahindra, and the Ramco Cements. 68 of them have seen short covering, and this includes the like of something like Z, Delta, HCL, Eicher Motors, and Havells India. Now, what you need to keep on your list, these are the ones essentially which are under FNO ban. NSE has added RBL Bank to its FNO ban list for July 17 after the sharp move that we saw on Friday. It has retained Delta Corp and Hindustan Copper, Indiabull Housing Finance, Manappuram Finance, and Punjab National Bank. These are some of the other securities that have been retained in overall the FNO ban. Now, let us get going and discuss some stocks and strategies with Hemen Kapadia. Good morning there. Hemen, how are you doing?
To you, Nickey. Thank you for having me.
Pleasure is all ours. I'm going to start off by asking you about your strategy on Nifty and Bank Nifty levels to watch out for. It's going to be a crucial earning heavy week. How are you looking at it, and what would you suggest to the viewers out there?
Frankly speaking, Nifty is posted a new high, Nickey, but looks just a bit wobbly. So but once again, there's no advice to short because the markets remain in a very strong bull grip. So I'd say it would be more like a buy on declines. In terms of levels, support comes in at 19,524, 19,300. This move remains safe as long as we, at least in the near term, as long as we sustain above 19,300. If we close below 19,300, currently that's not on the horizon, but I think that would be the first warning signal as far as the market is concerned. Bank Nifty has been corrected for 8 trading sessions in a row, Nickey. So I think that would be a very interesting thing. Okay, markets are expected to open soft. Support for Bank Nifty comes in at 44,600. Resistance comes in at 45,085, 45,184, and 45,400. So if they do open a bit weak, I would suggest one can go long on the Bank Nifty, keeping 40. These are spot levels, Nickey. One can go long in the Bank Nifty, keeping 44,600 as a stop loss. Nickey.
Sure. I also wanted to chat about IT stocks. Do you think there is also HDFC Bank will be reporting in the numbers? Strategy for these two, and then of course 2 recommendations from you for our viewers out there.
Okay, as far as HDFC Bank is concerned, we've come off 125 points almost from the high, 140 points, Nickey. But having said that, we are getting close to strong supports, 1620, 1600 and 1580. I believe these are adjustments happening because of various weightages being changing because of merging of HDFC and HDFC Bank. So uh, I'm not trying to second guess the results. But if HDFC Bank comes in to closer to 1620, I would take a contra buy call. I mean, I see it going back to 1750 in the next month or so. So, frankly speaking, not much to lose over here. But once again, ideally, one would need to wait for the results and see how the combined entity reports. Otherwise, in terms of individual stocks, I think firstly, one can buy Aarti Industries from an intraday point of view at 452, stop loss 448, target 460. Secondly, one can buy Ashok Leyland from an intraday point of view. One can buy, I mean, I'm giving levels slightly a rupee lower simply because we're going to open a bit weak or soft. One can buy Ashok Leyland 170, stop loss 167, target 176. Both of these are intraday buy calls. Nickey.
Sure, Hemen. I'm going to also chat about RBL and Delta Corp with you, beg your pardon, and ask you about the strategy. But I'm going to first address the stocks and news that needs to be watched out or kept in mind before we, up for trade out there. Bandhan Bank, Avenue Supermarts, and Saturn Credit Care Networks. These are some of the companies that you need to keep on your list this morning. Bandhan Bank has Q1 earnings has been a bit of miss. Profit has fallen almost 19% year-on-year. Asset quality has weakened, and the bank has reported lower net interest income and pre-provisioning operating profit. Overall, NII has dropped by 0.9%, and NIM has declined by 70 basis points to 7.3% in the quarter gone by. Asset quality has weakened with the gross NPA, essentially, which is rising by as much as 189% to 6.76%. Essentially, if you look at the NPA rising figure, it's not a great sign, right? The asset quality, it means, is weakening out there. Let's talk about Avenue Supermarts. Largely in line with estimates, Q1 profits has grown by 2.3% year-on-year. And if you talk about the margins, they have been a little bit on the lower side. Revenue for the quarter, however, top line growth, 18% growth year-on-year. EBITDA is flat, but is up by almost 2.8%. Margins, like I indicated, they've taken a bit of a drop there. What I'd also like to watch out for will be Saturn Credit Care Network. SBI Emerging Asia Financial Sector Fund has exit in the entire 2.07% stake overall in the company. These shares were sold at an average price of 178 per share. So that's a bit of discount there, and a mutual fund house also exiting out of the counter. Just Dial, another one that you need to keep on your list based on earnings. Report Q1 number, and that comes in at the profitability is at 83 crore. There's been a healthy performance, and the profits have been registered as compared to a loss in the corresponding quarter of the previous year, which was to an extent of 48 crore. Talk about the top line, 33% growth out there, and the traffic overall has been risen by 15.9% year-on-year, along with overall, that's the mobile traffic increasing to an extent of 18% on the list. So these are a set of numbers that, we'd be looking at. Of course, Just Dial and Bandhan Bank are some of these. Also, Netweb Technologies, yet another an IPO, would be up for subscription. It opens for subscription today. Much of AI-related technology also involved, almost 8% revenue out there. But let's address the market open for you first. Nifty 50, we are looking to gains to an extent of 0.1% out there. A little away from that 19,600 level, but still thereabouts, keeping the head above the water, which is great because given the Asian markets have been a little bit of wobbly, and US markets had ended, on a mixed note on Friday. So that's a bit of a positive development coming in for the markets right now. And overall, if you look at Bank Nifty Index, that's also the one which is doing well with gains of 0.1% out there. In terms of the other sectoral indices, broader indices that we have, mid-cap index is outperforming, gains to an extent of 0.3% out there. And in terms of small cap index, that's the one which is outperforming, and outperforming by a margin. More than 0.5% of gains coming in on that one. So clearly market breadth right now in the favor of advances, 43 advances as compared to 6 declines. that we are looking at right now. And let's see other sectoral indices, how they've been faring. Nifty IT. Well, we have a good note written on whether it's time to enter into IT stocks right now. That's the homepage story on moneycontrol.com. Right now, the IT stock index entire basket is down and out by 0.4% out there. In terms of other sectoral indices that we have overall, metal index seems to be doing well to an extent of 0.4% of gains coming in on that one. And in terms of pharma index, that is also holding up well overall. We are seeing gains to an extent of 0.5% out there. Talk about FMCG, yet another defensive name out there. It's holding up. 0.3% of gain coming in on that one is also. And if you also talk about auto index, that's been doing well to an extent of 0.2% out there. Let's also talk about the other sectoral indices like healthcare index too seems to be doing fine. Let's look at the top gainers and the top losers on the list just to see where the flavor is and how HDFC Bank essentially is doing. It's going to be reporting in the numbers. Power Grid, Adani Enterprises and Britannia. These are some of the top gainers that we have on the list right now. Adani Ports, Ultratech Cement and Apollo Hospital. Some of the other, gainers, essentially, it's the auto counters which have been doing well and are one of the top gainers on the list right now. Let's also talk about the top losers that we have on the screen. ONGC, Infosys and Hindalco. These are some of the top losers that we have on the screen. TCS and Tech Mahindra. Also a bit of IT names which have featured into the list. So it's a mixed bag. Auto seems to be on the gaining side and, IT stocks right now. You'll see LTI Mindtree and Tata Alexi. These are going to be two names essentially from the mid-cap space which are going to be reporting in the numbers. In the previous quarter, you saw mid-cap IT names doing well. In this quarter, will the trend be any different? Remains to be seen. So far, if you talk about the large cap IT stocks, they seem to have delivered in line with muted set of expectation. No shockers there, but no surprises either. Hemen, I'm going to come back to you and check with you about RBL Bank and of course Delta Corp, which is in the F&O ban right now. But what do you make out of something like an RBL Bank too? I believe that is also under F&O ban, right?
Yes, that's all the momentum. Participation is restricted, Nickey. But yes, from a longer term point of view, RBL Bank is slowly and steadily setting the stage for going past 250. So I don't think if you are an investor or if you have a slightly longer term view, nothing much to worry. Yes, Delta, I think, has fallen off a cliff based on the government's decision on GST. Very strong support comes in at 170. And now with a ban, I believe it'll hang around over here. I don't expect too much of action. But yes, if it closes below 170, could be a cause of some concern. Otherwise, I think it's absolutely fine. I think it seems to have overreacted. I don't think there's much to worry about now.
All right, Mr. Kapadia, we'll leave it at that. Thank you so much for taking out the time and speaking to us this morning. All right, let's understand and navigate through the fundamental story. It's been a bull market and it's been a secular one, but we're going to be talking about the fundamentals in just a bit. But before that, let's talk about Netweb Technologies. That's the IPO. It's a Delhi-based high-end computing solutions, a provider essentially, which is set to launch its initial public offering on July 17th. The IPO essentially aims to raise around 631 odd crore and includes an offer for share to an extent of 8.5 million equity shares. The price band for the shares has been set at rupees 475 to 500 per equity share. And we'll be joining in, Nitin Sharma in a bit will be joining us to take the discussion forward. But before that, we need to address the fundamental side and how we're stacking up. But let's look at what HDFC Bank, RIL and Infosys have been doing. It's an earning heavy week and it needs to be seen how these stocks are stacking up for now. Looks at the market right now, it is a positive opening coming in for the markets. And if you talk about the overall global counterparts, there was a mixed trend. But somehow if you look at the market, it looks like a secular uptrend which is coming in for the markets. And even a bit of breather coming in from the US market, or for that matter Asian markets. Indian equity markets seem to have mind of their own these days, DIIs, they've been sellers in the last 15 odd sessions. We've seen a lot of retail investors essentially, which have been holding up well, not holding up well, beg your pardon, have been selling equities, and the amount is huge in the last 15 odd days. So that's a bit of, that's a bit of disappointment coming in for the equity markets. But overall, if you look at the FII trend, that is the one which remains steady. But to take us the discussion, joining us right now in the morning is Harish Krishnan, EVP, Kotak AMC. Good morning there. Harish, hi. Am I audible?
Yes, you are.
All right.
Good morning.
So I'm going to start off by asking your assessment overall for the IT stocks. Do you think it is a good entry point at this point of time, given the kind of correction that the sector has already witnessed? A bit of, the top line, the large cap companies, frontline, basically, they have delivered muted set of inline numbers. And today you'd see the mid cap names, essentially, something like Tata Elxsi, also reporting in their numbers. What do you make out of it? Do you think it's a good entry point for the investors out there?
So, we tend to look at things on a 3-year rolling basis, right?
Sure.
Now, if we look at from that lens, we do think that IT does provide an opportunity. So let me lay out that we have in the form of IT. So we plot for all sectors, the profit pool share as a percentage of total profits. Now that varies, as you would imagine, depending on how other sectors also perform, as well as how this particular sector performs. Now, IT generally has been on a ascendancy. Broadly, if I were to take a 25-year trend, it typically tends to move up. Right now, if you look at how it has happened over, say, the last 20 years, the profit pool share has varied from 5% when the dot-com bubble burst. It went to 8% of total profits during the GFC, the global financial crisis in 2007-8. Then it went to about 12-13% in the pre-COVID, disruption. And then during COVID, of course, the sector got into the limelight because all other sectors were doing poorly, and this sector got the benefit of both accelerated demand as well as higher margins because they weren't really spending on travel, etc. And that went to about 15%. Today, that number is back to about 8-9%, right? So the call essentially that one is taking is whether this 8-9% is going to remain at 8-9% for the next 2-3 years, or whether it's likely to go to about 12-13% in the next 2-3 years. And I would think that there is a reasonable chance that it can go to about 12-13%. Of course, the fact that there is a slowdown in the near term is pretty obvious. I mean, this is possibly the most well-advertised recession in the making over the last 18 odd months. And therefore, yes, the near term might be a lot more volatile, but we do think that it does provide an interesting juncture wherein one can look to add the sector in our portfolios.
Sure, I'm sure you'd not be able to talk more stock specific out there, but if you were supposed to just look at within the space bifurcation, would you want to go with the top line names or something like a mid caps also work given the outperformance in the previous quarter?
So I think it's a mixed bag. The larger names have the benefit of better valuations today because they all are available at very good FCF yield, free cash flow yields, anywhere between 5 to 6% free cash flow yields. So you have valuations on your support over there. However, do keep in mind that the large cap is also quite vulnerable to the changing trends and disruptions because there is a leaking bucket, right? Because with disruptions in the form of technologies like AI, Chat GPT, etc., you're likely to see a significant amount of disruption at a lot of spaces, including say infra, BPO, and which is where traditionally the larger companies have a larger offering. So the way we look at it is look stock by stock, which are the areas where we think they have a right to win in the emerging areas and where the leaking bucket is lower, and then place our bets, obviously in conjunction with the valuations that they all trade at.
Mr. Krishnan, very broad-based question out there. How are you viewing the Indian story, Indian equity market story? It seems like a bull run which is secular in nature. But overall, if you see the FIIs have been buying in, they've continued to bet into Indian equities. It's infused almost to an extent of 30,600 crore in the first fortnight of this month itself. How are you overall looking at the sentiment right now in terms of the anti-China sentiment, FII pouring in money, You have flurry of IPOs being flooded in the markets. Do you sense some caution?
So I think all of these are, transient trends, be it the sentiment against China or the favor that, Indian companies, etc., are going through. I think there is a cyclical aspect of these trends which is helping India at this point of time, which is basically money is moving out from China, say, and India is considered to be possibly less insulated from the global slowdown because most of our companies are more run by the domestic cycle than by the global cycle. So that is the cyclical aspect over there. The structural aspect is, I think, well bought into today, which is that, compared to the rest of the world, where population and demographics is significantly challenged, India provides a very credible alternative, of course, buffeted by the fact that we have some very good management teams and a long runway of growth. So I think the key aspect is at what point do the cyclical, today we are in a point where both cyclical and structural are getting rewarded. At some point, the cyclical factors will fade out and then only the structural factors will remain. And then you get the other extreme wherein while people understand the structural factors, they may still take a cyclical aspect in terms of say near-term earnings, etc. So in that respect, today, we are in 10 on 10 on both aspects, both the cyclical story as well as the structural story. And therefore, we do think that, in the near term, one should be a bit cautious. Clearly, we are enthused by the overall market. I think 3-5 years from now, we do think that markets will reward unit holders, but the expectations need to be moderated significantly, even over a 3-5 year horizon. And in the near term, we do think that there will be a reasonable amount of caution that we do think is likely to play out.
All right. I also wanted to chat about the small cap story. You think there is a bit of bubble out there because managers, the fund managers are saying that the valuations haven't yet peaked. But at the same time, many fund houses have started shutting their doors to hot money, especially for the small cap index. What's your fund house call overall on this issue? Are you also, probably contemplating shutting the doors on the lump sum investments coming in for the small cap category? How are you viewing at it? What do you think about the valuations?
So it's right that I think valuations are a bit expensive, especially in conjunction. So generally, mid cap and small caps tend to be at a discount on valuation compared to large cap, and that's primarily because larger companies have seen more cycles. They tend to have better margins overall, and they generally have a lower cost of capital because banks preferably or lenders typically tend to lend towards them first compared to mid and small cap. And so today you are in a zone wherein the valuation discount is pretty much non-existent between large and small caps. So clearly in the near term, we do think that, large caps are a better place to be in than small caps. However, we do acknowledge the fact that over a 5 year cycle, typically small caps tend to be more rewarding. And so if you genuinely have that kind of a horizon plus, we don't think that one should completely shut off small caps at this point of time. So we are advising investors to follow asset allocation at this point of time. There's a lot of money chasing small caps, and possibly that is led by the fact that the 10-year returns are supremely good. Because remember, 10 years back, we were the fragile five in 2013. And therefore, the entry point of valuations for small and mid cap were extremely cheap, and which is what led by earnings growth and by a huge valuation re-rating, we've seen a significant spike up in overall returns. We would think that the coming 5 years, the dispersion between large, mid, and small cap A is not going to be so large. Small caps do provide a better return potential, but the dispersion is not going to be that large.
All right, Mr. Krishnan, I understand your approach overall of looking at equity markets from a very long-term view in the sense that at least a 3-year horizon. But if you were just supposed to look into a little short-term assessment out there, just for the earnings season for that matter, which are the themes technically that the fund out is typically gung-ho on in this quarter, and the stocks that you think would do exceptionally well within that basket?
So I think some context over here. The last year, around the same time, we were in amidst the revenge consumption spree, right? Given the fact that we had a significant lockdown for about 12-18 months, we had a significant amount of spending coming through, and that lifted the top line of a lot of companies. Also, at that point of time, there was significant amount of inflationary cost, which meant that companies, tried to pass on cost, but their margins got impacted big time. Today, we are in a way a completely different trajectory, wherein we think that top lines are the growth in top lines. Let me put it that way, is likely to see some kind of a moderation. They'll still be growing, but the growth rates are going to be much lower. But margins is where we think we are a lot more positive on that. The margin delta is going to be a lot more stronger. So our preference would be in those sectors and stocks which have reasonable margin levers in the near term. Of course, if you demonstrate both volume growth and margin expansion, nothing like it, because it's a very difficult environment globally as well as within the Indian economy as well. And so if you are able to demonstrate both, nothing like it. But we think that companies or sectors which show better margin potential in the near term are likely to be rewarded. Case in point being, say, the cement sector, wherein clearly the energy costs are the single largest cost, and that has moderated quite significantly. Similarly, if you look at gas utilities, another sector where there was significant amount of cost increases when the Ukrainian invasion was first announced, as Europe went into stockpiling mode, we think that could be a beneficiary. A lot of building material companies again had seen margins compressed. That could kind of see some benefit. So those are the 3-4 sectors where we think the near term from a margin perspective is slightly better off compared to many other sectors.
All right, Mr. Krishnan, we'll leave it at that, but thank you so much for taking out the time and speaking to us this morning. It was indeed a pleasure chatting with you. All right, that was Harish Krishnan out there talking about the small cap and his preference towards gas, utility and cement space. But let's navigate our discussion now to Nitin Sharma from MC Pro, who joins us to take us and talk about essentially Netweb Technologies, which opens for subscription today. It's aiming to raise a sum to an extent of 631 crore. It's a combination of both fresh issue as well as OFS. Let's patch in Nitin on that note. Good morning there, Nitin.
Hi.
All right, I just wanted to understand, what do you make out of this IPO, concerns and advantages, key highlights, if one was supposed to invest in an IPO?
Yeah, good morning. Yes, so the IPO is opening today. If I talk about briefly about the key positives and key negatives for concerns area, then starting with the key positives. So first of all, the high performance computing and the private cloud space, that's where the company operates, is a high growth business. And if you look at in the last 2 years, company's revenue grew by around 76% CAGR. Driven by the supercomputing and the private cloud and HCI segment, which themselves grew by 253% and 90% respectively. Now, according to Frost & Sullivan, these segments are expected to grow by high single digit to double digit over the next 5 to 6 years. And this sort of rapid growth is going to help Netweb because they still have a very nascent market share, and as the industry expands, they continue to gain market share. That will help drive their revenue in the coming years. Secondly, the company is an integrated player, so basically they provide designing, developing, and implementing the high-end computing solutions. So when you look at from a client perspective who may not have an in-house expertise to roll out such programs, it becomes a one-stop shop solution. So they'll take care of the equipment as well as the implementations. Typically, what happens is that the other players offer one or the two part of the entire value chain, and then the client have to buy third-party software, contact to another third party for the implementation, etc. So in that sense, it fare well against the competition, being a integrated player. Finally, I think the production link is cleaned up, as known as PLIs. So company has already the PLI in the IT hardware space, specifically for servers. And for that, they have already met the threshold limit for the investment and the sales for the first year. So they've claimed it. And now, since with the PLI 2.0 for IT hardware, the pool of incentive has doubled, so making it fairly attractive for them. And earning more incentives as they go ahead. So these are the key positives. If I talk about concern areas, so then first of all, it's a highly specialized field with a very small local market, and company competes with the large players. So in this sense, the supercomputing space, from where companies drive their 40% of the revenue, globally it's a $12 billion per year kind of a market, which is not growing, basically flat. And whatever growth that is being driven is from the Asian market. Nonetheless, this is going to attract stiff competition. Also, companies, 50% of the revenue comes from the government projects. So, which is, in my view, it's a significant concentration risk. Even if I talk about the up-and-coming AI space, so, of course, the AI spending on the hardware, software, and services are expected to grow at a CAGR of 27% to reach around $300 billion by 2026. But of this spending, 50% will happen in US, another 20% by the Europe, and another 20% by China. So for India, spending would be closer to 1% of the global spending. So while market is relatively small, but the competition is there, and company plans to expand it to overseas market will not be easy because there are significantly large players such as NVIDIA, HP, etc.
Okay, Nitin, I'm sorry to interrupt you in between, but just one last question that I'd want to squeeze in, and just 30 seconds on that. I would want to understand, what do you think about the financials, threefold jump in revenues and an eightfold jump in profits in 2 years? And how is the valuation stacking up as compared to the other counterparts? And is MC Pro giving a subscribe to this issue?
Right. So basically, the jump in the revenue is there, but it's on the lower base, first of all. What we like is that there is a decent margin around 16%. It has been consistently increased since from the reported period. FY23 is around 16%. Nonetheless, having said that, when you look at the valuation-wise, so it is being valued at around 60 times of FY23 PE, which in our view is expensive, partially because you cannot compare it with the EMS companies. They are entirely different business, and better peers for them to compare are NVIDIA, VMware, HP Enterprise, Nutanix, and Atos. And when you compare to that set of peer group, basically they are valued higher than those larger players. So in that sense, it's expensive. Nonetheless, because IPO market is pretty hot, a lot of interest with the technology and manufacturing sector IPOs. So we are of the view that there is a potential for the listing gains, and hence investors can apply purely for the listing gains.
All right, Nitin, point well taken. Investors can look at this IPO if they're more so of an listing game play out there. But Nitin, thank you so much for taking out the time and speaking to us this morning. All right, that was Netweb Technologies. But with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching, and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.